We now move to the total outlay method of calculating price elasticity. The price elasticity of a demand for a commodity and the total expenditure or outlay made on it are very much related to each other. That is, the demand for the commodity and the price elasticity of its demand, when it is compared with the expenditure of the product or the outlay made for the product, are closely related to each other. The total expenditure is nothing but the price of the commodity into the quantity of the commodity purchased is related to the total revenue received by the seller. That means the number of commodities sold into the price paid for the commodity. By analyzing the changes in total expenditure or total revenue in response to the change in the price, we can understand the price elasticity of the demand. Now, the price elasticity of demand can either be equal to 1 or unity, or it can be either greater than unity or less than unity. Let us in detail see what is meant by these. Price elasticity of demand, if it is equal to 1 or when it is set to unity, what does it mean? That means the result of the change in price of a good is equal to the total expenditure on the good or the total revenue received from that good remains the same. The price elasticity for the good is equal to unity. This is because when the expenditure made for the good remains the same only to the proportional change in the quantity demanded and is equal to the proportional change in price, then it is said to be the price elasticity is equal to 1. Total percentage increase in the price of the good and the price elasticity is unitary, and the total expenditure of the buyer or the total revenue received from it will remain unchanged. There is no change in the price elasticity, or it is equal, unitary, or the total revenue received remains unchanged. So in that case, the price elasticity of demand is equal to 1. When is it greater than unity? When the result of increase in the price of a good increases the total expenditure on the good or increases the total revenue from the good or decreases the total revenue of the good, then the total expenditure made on the good or received from the good, whether it increases or decreases, we say that price elasticity of demand is greater than unity. Say for example, in the headphone case, the headphone prices falls from 500 to 400. So what is the revenue earned from selling this number of headphones when it reduces to 400 from 500? The total revenue earned from selling of the headphones increases from 50,000 to 60,000. So indicating elasticity of demand for headphones. Similarly, when the price rises to 400 to 500, the demand would reduce. Say for example, the demand fell from 150 to 100. So the revenue also fell from 60,000 to 50,000. That is, an increase in the price decreased the revenue, and the decrease in the price increased the revenue. Here the price elasticity is said to be greater than unity. Now we move on to less than unity. When is price elasticity of demand said to be less than the unity? Now first let me give the example and then explain to you children. In the case of wheat, we saw when the price reduced from 20 per kg to 18 per kg, the revenue received from the wheat falls from when 20 units of 20 rupees was the price per kg, the demand was 500 units, so the revenue earned was 10,000. But when it decreased to 18, the monetary benefit, the total revenue earned for 520 kgs was only rupees 9,360. And now see here, the price decreased, the quantity or the total revenue earned by selling also decreased. This indicates inelasticity of revenue. That is, when it was 18 per kg, the total revenue was 9,360, and when it was 20 per kg, the revenue was 10,000. Even though the quantity demanded increased, the revenue decreased. So the main drawback of this method is we can only say whether the demand is elastic or inelastic. We cannot find the correct coefficient of price elasticity.